Canada built its economic model on two pillars: mass immigration to drive growth and knowledge work as the path to middle class. Today we have data suggesting both are wobbling at the same time, and the Bank of Canada has 2 weeks to decide what to do about it. Welcome back to the Daily Brief Canadian Macro. I'm Steve. 3 stories today that connect in ways the headlines aren't showing you. Minority Mindset broke down which jobs will actually survive the AI wave, and the answer has a direct read through to Canadian investors. Then we're looking at Fresh Statistics Canada data showing population growth has turned negative in Ontario and BC for the first time since 1946. And finally, we unpack why March's jobs numbers, which look like good news on the surface, are actually setting up a genuinely difficult call for the Bank of Canada on April 29th. Let's get into it. Over on Minority Mindset, the focus is on jobs which will survive AI disruption through 2030, and the starting point is a pattern reversal that hasn't happened in living memory. For the first time, new technology is coming for white-collar workers before manual ones. Multiple AI leaders, including Anthropic's own CEO, have warned publicly that half or more of entry-level white-collar jobs could be automated within a few years. Silicon Valley is already replacing junior employees with AI agents, and the disruption is concentrated at the bottom of the knowledge work ladder. Administrative roles, junior analysts, legal researchers, and entry-level coders are just some of the casualties. 5 job categories are emerging as genuinely AI resistant: skilled trades, high-end business-to-business sales built on relationships, AI implementation specialists, entrepreneurs who deploy AI rather than compete with it, and healthcare roles requiring human presence and judgment. What connects them is that they either require physical dexterity, deep interpersonal trust, or the ability to direct AI rather than be replaced by it. The investment angle here is concrete. BlackRock announced a $100 million 5-year initiative to expand training, especially for electricians, plumbers, and HVAC technicians. This isn't philanthropy. Electrical work alone accounts for 45 to 70% of total data center construction costs, and there simply aren't enough qualified tradespeople to build the AI infrastructure the world is demanding. BlackRock is investing in trades training because the bottleneck to the entire AI build-out is physical labor. For Canadian investors watching the energy and infrastructure sectors, that's a signal worth taking seriously. This is a story that hasn't broken through on YouTube yet, and it has direct implications for a wide range of Canadian equity positions. Statistics Canada data shows year-over-year population growth has already turned negative in Ontario and BC as of Q4 2025, the first time since 1946 outside of the pandemic. This isn't a projection, it's already happened. The driver is the federal government's deliberate reversal on non-permanent resident targets. After years of running population growth at 3% annually, among the highest in the developed world, Ottawa has pulled hard in the other direction. The Bank of Canada now projects the labour force will be measurably smaller by the end of 2026, with subdued growth extending into 2027 and 2028. For investors, this quietly dismantles a core assumption behind a wide range of Canadian equities. Consumer-facing businesses, purpose-built rental REITs, and retail stocks across Ontario and BC were largely priced on the assumption that Canada's population growth engine would keep running indefinitely. That engine has been throttled, and the repricing hasn't fully happened yet. The regional picture is where it gets interesting for portfolio positioning. Alberta and Saskatchewan are not seeing this decline. They're actually absorbing internal migration from Ontario and BC as workers move west, chasing lower costs and a stronger job market. The energy tailwind from elevated oil prices compounds that advantage. So the same national demographic picture that's concerning at the index level contains genuine regional opportunity, if you know where to look. Finally, the labor report is in, and Canada added 14,000 jobs in March after losing 84,000 in February. On the surface, that sounds like a bounce. BMO's chief economist put it plainly: no one should mistake this small rebound for a sign of strength. The March gain claws back less than a fifth what was lost over the prior 2 months, and the unemployment rate held flat at 6.7%. Youth and entry-level workers are absorbing the most pain, consistent with what Minority Mindset flagged about where AI disruption is landing first. But the reason this number matters beyond the headline is what it sets up for April 29th, when the Bank of Canada makes its rate decision. The BOC is sitting on a genuinely uncomfortable split signal right now. The labor market has cut 2 consecutive weak job reports, a Q4 GDP contraction of 0.6%, and a population picture that's structurally deteriorating. But the oil shock from the Strait of Hormuz says hold. Energy-driven inflation is pushing back up, and the BOC doesn't want to be seen easing into a price shock. The bank held at 2.25% in March and signaled it would look through the energy inflation as a temporary supply shock. That may still be the right call, but April 29th is a live decision in a way the market isn't fully pricing, and a surprise cut, or even unusually dovish language, could move Canadian bond yields and the loonie meaningfully. It's worth watching. What connects today's 3 stories is that Canada's post-pandemic growth model ran on 2 engines simultaneously: a large and growing labor force powered by immigration, and a knowledge worker middle class generating the tax base and consumer spending that held everything together. The AI story from Minority Mindset suggests the knowledge work engine is under serious structural pressure from above. The population data shows the immigration engine has been deliberately throttled from below, and the March jobs number is the first data point showing both pressures arriving at the same time, with the Bank of Canada now caught between them. The question for Canadian investors isn't simply whether to be bullish or bearish on Canada, it's whether the specific equities you hold were priced for the old model or the new one. Consumer facing businesses in Ontario and BC priced for perpetual population growth, and employers of junior white collar workers priced for a stable knowledge economy workforce both deserve a harder look right now. Energy producers and skilled trades adjacent companies, like the ones BlackRock is literally funding, look structurally better positioned for where this is heading. Well, that's your daily read for today. All credit goes to the creator featured. Their original analysis and video is linked in the description below. If you found this helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and comment if there's a creator you think deserves a highlight. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and speak with a qualified financial advisor before making any investment decisions. Good night.